The accounting equation is the backbone of double-entry bookkeeping. It states that assets equals liabilities plus equity. Think of a small shop as a seesaw. The left side holds everything the shop owns, cash, inventory, equipment, while the right side holds everything the shop owes, loans, supplier bills, plus what the owner has invested. If the left side goes up, the right side must also rise by the same amount to keep the seesaw balanced. This logical foundation comes from the definition of equity as the residual interest. What is left over after you subtract what the business owes from what it owns? In other words, equity equals assets minus liabilities, which rearranges to the classic form above. The equation works for any business at any point in time and provides a constant check that the books are internally consistent. Assets, liabilities, and equity are each a broad bucket with distinct traits. Assets are resources the firm controls that are expected to bring future economic benefit. They are classified as current cash, accounts receivable, inventory, items likely to be turned into cash within a year, or non-current property, plant, equipment, long-term investments. Liabilities are present obligations to outsiders that will require future outflows of resources. Like assets, they split into current, accounts payable, short-term loans, taxes payable, and non-current, long-term debt, deferred tax liabilities. Equity represents the owner's claim on the business after liabilities are paid. It includes contributed capital, owner's cash or other assets put into the firm, retained earnings, profits kept in the business, and sometimes other comprehensive income, foreign currency adjustments, unrealized gains. The key characteristic is that assets have a positive effect on the left side of the equation, while liabilities and equity add to the right side. Together, they must always equal the asset total. The equation can be expressed in a change-oriented form to show how transactions affect balances. Delta assets equals delta liabilities plus delta equity. Here, delta denotes change. For every transaction, the amount added to assets must be matched by an equal addition to either liabilities or equity, or a subtraction from one of them. For example, if a company borrows $10,000 from a bank, delta assets equals plus $10,000 cash increase, and delta liabilities equals plus $10,000 loan liability increase, while delta equity equals 0, keeping the equation balanced. Algebraically, starting from assets equals liabilities plus equity, subtract the prior period values. Assets 1 minus assets 0 equals liabilities 1 minus liabilities 0 plus equity 1 minus equity 0, which is exactly delta assets equals delta liabilities plus delta equity. This formulation is useful for analyzing how profit, investment, or expense flows move the financial position of the firm. Dual-entry bookkeeping is the practical engine that enforces the accounting equation. Every financial event is recorded as two equal and opposite entries, a debit in one account and a credit in another. Because debits increase assets and expenses but decrease liabilities, equity, and revenue, and credits do the opposite, the total of all debits always equals the total of all credits. This symmetry guarantees that assets equals liabilities plus equity after each posting. For instance, when you purchase equipment for cash, you debit the equipment account, asset up, and credit cash, asset down. The net effect on total assets is 0, and because no liability or equity changed, the equation remains balanced. If you instead buy on credit, you debit equipment, asset up, and credit accounts payable, liability up. Here, both sides of the equation increase by the same amount, preserving balance. Revenue earned for cash, sell service for $5,000 cash. Delta assets cash equals plus $5,000. Delta equity retained earnings equals plus $5,000. Profit increases equity. Equation plus $5,000 equals 0 plus $5,000. Revenue earned on credit, invoice a client $3,000. Delta assets accounts receivable equals plus $3,000. Delta equity retained earnings equals plus $3,000. Balance plus $3,000 equals 0 plus $3,000. Expense paid cash, pay $1,200 for rent. Delta assets cash equals minus $1,200. Delta equity retained earnings equals minus $1,200. Expense reduces profit. Balance minus $1,200 equals 0 plus minus $1,200. Capital infusion, owner puts $10,000 cash into the business. Delta assets cash equals plus $10,000. Delta equity contributed capital equals plus $10,000. Balance plus $10,000 equals 0 plus $10,000. Bank loan borrow $15,000. Delta assets cash equals plus $15,000. Delta liabilities notes payable equals plus $15,000. Balance plus $15,000 equals $15,000 plus 0. A balance sheet is simply a snapshot that lists the two sides of the accounting equation at a point in time. The left side shows assets grouped by liquidity, current versus non-current. The right side groups liabilities, current first then long-term above equity, which includes common stock, additional paid-in capital, and retained earnings. Because the sheet must balance, the total of the asset column must equal the sum of the liability and equity columns. Any discrepancy signals an error. For example, assume a firm's assets are cash $20,000, inventory $30,000, equipment $50,000, total $100,000. Liabilities are accounts payable $15,000 and long-term debt $35,000, total $50,000. Equity must therefore be $50,000. For example, common stock $20,000 plus retained earnings $30,000. To make the equation, $100,000 equals $50,000 plus $50,000. By reading the balance sheet, investors instantly see the firm's capital structure and can assess solvency. Explanation: because the accounting equation links the three major financial statements, it also underpins many performance ratios. Debt-to-equity ratio equals total liabilities divided by total equity. It tells how much debt the firm uses relative to owner's money. Using the previous example, debt-to-equity equals $50,000 divided by $50,000 equals 1.0, meaning half of the financing is debt. Current ratio equals current assets divided by current liabilities. It measures short-term liquidity. If current assets equal cash $20,000 plus accounts receivable $10,000 plus inventory $15,000 equals $45,000, and current liabilities equal accounts payable $15,000 plus short-term debt $5,000 equals $20,000, the current ratio equals 45,000 divided by 20,000 equals 2.25, indicating good ability to pay imminent bills. These calculations are direct manipulations of the equation's components and help analysts compare firms, track trends, and decide on credit or investment. When a corporate group owns several subsidiaries, the accounting equation must be applied at both the consolidated and segment levels. In consolidation, the parent's investment in subsidiaries is eliminated, and the assets and liabilities of subsidiaries are added together. The equation becomes consolidated assets equals consolidated liabilities plus consolidated equity, where equity now includes the parent's equity plus any non-controlling interest. For segment reporting, each business line reports its own mini balance sheet. Segment assets equals segment liabilities plus segment equity. However, because some assets like corporate headquarters are shared, allocations are required. The underlying principle stays the same. Each reporting level must balance, ensuring no double counting of inter-company balances. Typical exam questions test your ability to move from a transaction description to the balanced equation, and sometimes to a balance sheet format. A common patterns. 1. Identify which accounts are affected: asset, liability, equity, revenue, expense. 2. Determine the direction of each change, increase or decrease, and whether it is a debit or credit. 3. Apply the delta assets equals delta liabilities plus delta equity formula to check balance. 4. Post the journal entry and update the trial balance. Strategy tip: always start with the big picture. Does the transaction add cash, create a receivable, increase debt, or affect owner's equity? Then write the equation side by side. Practice with variations, for example, purchase of equipment with a mixture of cash and loan, to become comfortable with multi-step changes. Remember that revenue and expense ultimately flow into equity, retained earnings, so even a simple cash sale will increase both assets and equity.